All right, at this point, you should know what an SDIRA is, the rules behind them, how to open an account, how to grow it if you don't think you have sufficient income. And this video, well, again, if you don't know those rules, go to the prior ones in the series. There's a lot of good, great info in there. It'll catch you up to speed. But for this one specifically, we're going to go deep dive into an actual deal that I purchased with my SDIRA. So let's get into it. So with this one, what and where are we talking about? So what is the asset and where did we find it? So in this case, we've got ourselves, it was a 2022 new build home. So 2022, it was built in 2022. Purchase price, so just put P, so 434,900. That was the purchase price. That's what it was listed as. This was an on-market listing. So that was the purchase price. This is a 4-bedroom, 4-bed, 3-bath. So this one, as I mentioned, listed on the market. So where did we find it? Well, I wasn't actually looking on the MLS. I wasn't looking on Zillow, anything like that. I was actually, believe it or not, just walking my dog, walking with my family around the neighborhood. And I kept seeing this sign on this home. And as I'm calculating, we keep walking past it month after month. And finally I'm like, okay, this has got to be pretty high days on market. And I'll get into why that's important. So one of the days I finally decided, you know what, I'm going to give that realtor a call. Let's go home. I'm going to take a look and see kind of where things are at with this. Well, it turns out, so this was on market. Put the timeline here, right here. At that point in time, it was a little over 80 days on market. So 80 days on market. So that would consider that high days on market. Now, the other thing I'm looking at is they purchased it in 2022. So there is a high plausibility that probably don't have a huge amount of equity in this home. Now, why is that important? So why that's important is if they don't have high enough of equity, they probably can't budge on this price much, which is causing them to have even more difficulty in an already somewhat rough market to sell a home. So with that knowledge, I ended up calling up the agent. I'm like, hey, what's the situation on this home? What do we got going on here? And talking to her, she says, well, the home's actually empty right now. And the sellers, so they had a job relocation. The husband had a job that required them to move. They're actually living with their parents in another completely other state, and the house is just sitting there vacant. They're waiting for this home to sell so they can go purchase their next home. I'm like, that's not the greatest situation to be in. So as I was talking to her, I was like, so with this one, what's the wiggle room on your price? And as I expected, she said, really, there's not much. I'm like, okay, so it's really it's a low equity situation for these sellers. Okay. Well, you know what? I'm curious, would they be willing to sell it on some type of terms? Like, would they be willing for us to come in and we could give them the price they're looking for? We'll pay your commissions, the realtor commissions. We'll come in unrepresented on our side, so they don't have to pay the buy side at all. And then we'll pay the closing costs. One thing that we're looking for, though, is we want to come in and take over the payments on that already existing loan. We want to keep that in place. So it's a strategy. It's called subject to that underlying loan remaining in place. So subject to for short. Now we were talking through that and she goes, you know what? It could potentially work, but they're trying to buy their next home. So they can't have this, they can't have the note on this house still active because then it's going to affect what's called their DTI, their debt to income ratio. When they go to underwrite on their new loan for their next purchase, they're not going to be able to pass that. The bank's not going to let them qualify for a new loan for that next purchase. I'm like, okay, well, you know what we could do is, we've done this before, we could do what's called a lease purchase. Now, keep in mind, I mentioned lease purchases, not a lease option. So let's break this down. So say you've got a lease option. This is the lease option contract. And what you're saying in a lease option contract is you're going to go over here. Say you have an option fee that you paid. Say it's $5,000 to $10,000. And what you're saying is maybe, again, depending on the time frame, what you agreed on with that seller, 2 to 3 years. So I'm going to lease this for 2 to 3 years. And at that mark, I have the option, because I paid this option fee, I have the option to purchase that home. So I have the option. Now, whereas a lease purchase comes in, it's a little bit more definitive. So we've got a lease purchase here. Just put LP. Now in this instance, we're still going to be leasing the home for this period of time in here. And we're going to set this to whatever it needs to be. In this case, we'll get into it, but we set it for 12 months. So year lease. But in this instance, I'm leasing it, but at this point in time, it's not an option. I'm indicating, hey, I'm going to lease it for this period of time, and I'll have an opportunity to execute a purchase on it anytime in between. But at 12 months, no matter what, I'm purchasing this home at whatever agreed upon price that we have. So again, this is more definitive. Lease option is you have the option to purchase. Lease purchase, you will be purchasing that. So that's how that works. So I indicated to the realtor, hey, we can do the lease purchase agreement where the purchase side of the contract is, again, going back to that, we're taking over the payments of the loan. Now we can structure this to the way where it wipes off their DTI so they can fully qualify for their next purchase. Now, to explain that side of things, so really, if you see how this works is, we could have another example to where, say you have your own home here. And this is a very common example. This happens to people all the time. Say you've living in this home and you have to relocate for some odd reason and purchase another home, but you decide, hey, I want to keep this as a rental. And you're okay to do that. You have sufficient finances. If you're keeping this as a rental or a vacation home for you, as long as you have the income showing, like you have a lease in place, you provide that to your underwriter right off the bat. They're going to, if you got a 12-month lease, they're going to wipe off 75% of your debt to income ratio. Now, where ours was special is I was explaining to her, like, hey, if we do this lease purchase, we can structure it to where we'll meet that lease payment that they're looking for. They want to see that the mortgage, the PITI, is covered. So once that's covered, they want to also see 25% above that. So 125% of that payment, if they see that for a 12-month lease, then they can wipe off the full debt to income. So they can fully qualify for their next purchase. It essentially eliminates this in underwriting. It eliminates the note. I'll erase this. It eliminates the underlying note, that mortgage, from the seller's debt to income ratio when they go to purchase their next property. So reviewing that with the realtor, and she goes, you know, I mean, that could be an option, but I don't know. We'll see. She said she was going to talk to the seller on it. And again, I didn't put a full offer in writing because I just wanted to gauge where she was at. And really, realtors, they're not required to bring an offer or anything to the sellers of the home until they have something in writing. Because really, you don't want to, I mean, you don't want to get up hopes and you have nothing in writing. It has to be in writing for them to present it. So totally get that. Well, I left it alone, let her stew on it a little bit. The intent was, I'm going to put in a contract on this of like, hey, this is always going to be on the table for you. If it's not right for them now, that's totally fine. This option doesn't necessarily work for everybody, but for instances such as this, I have a feeling this is probably going to be one of their better options because we can likely put some cash in their pocket where they might be selling at a point where they're actually paying. So I told her, if you want to move forward with this option, all we need is, I need your mortgage statement, need their mortgage statement so I can assess what the offer exactly is going to look like for this case. Well, it ended up, she let this wait not too long. It was 90 days. And what's significant about this? So 90 days, that's 3 months. So a listing agent, commonly their listing agreement with the home seller is usually 3 to 6 months. So that's saying, hey, I have 3 to 6 months to sell your home. If I don't sell your home, then that listing, really the realtor, in essence, in lack of a better term, gets fired at that point. They didn't sell the home, the listing goes expired. So at that point in time, the homeowner has the choice to pick either another realtor or sell it on their own. So this realtor was at the point where like not getting offers. It wasn't selling at the price they needed it to sell. So she called me back up. She's like, hey, is that offer still on the table? I was like, of course it's on the table. Let's talk about it. I was like, well, could you set up a time? Can you talk to my sellers on it? Because I'm not exactly sure how to explain this to them. I'd like you to walk them through it. So I'm like, perfect. Let's set up a Zoom call. So we set up a Zoom call with the sellers, walked through this whole purchase, made sense. And the situation that they were in, going to the situation, they indicated, hey, we need to buy our home in the next 6 months. Now that's important. If they would have said 12 months, all I needed to do is we just do the standard purchase and sell agreement where with the terms that we're looking for, they're good to go in 12 months. After 12 months of payments, the guidelines for that underwriter, they can wipe that off. If they have a 12-month history, they can wipe off that lien 100% off the DTI for the home. So that's good to go. But because they said 6 months, that triggered for us like, okay, so we do have to go this lease purchase route, which I just explained. So we ended up structuring this for a lease purchase. So it's lease purchase. And what we indicated to them is, again, on the purchase side of the contract, we're going to take over payments. Now, looking at their loan, this one ended up having a 4.5% rate. So again, in this instance, we're buying the note. We're buying that rate. We want that rate because in today's market, especially as an investor, there is no way, absolutely no way I'm going to get 4.5% on a loan. It's going to be probably closer to 9% or higher, 8 to 9%, especially from an investor side of things. So this is very attractive on my end. Honestly, this is attractive on just your normal average everyday purchaser because we're not seeing rates like this currently. So went through that, and one of the things that kept coming up in the conversation, and I want to bring this up because it's an important point, is they kept saying, you know what, that's fine with you taking over the payments, but what about our equity? What? Okay. Well, I explained it a little bit up front, but let me explain this again. So there's actually, the common misconception is people see what I call gross equity. So gross equity. So gross, let's write this down here. Call it gross equity versus net equity. Versus net equity. So gross equity, this is the common misconception. A lot of people, they come in, so this purchase price, we got $435. Well, $434, $900. So what they had is they had a 402 and some change. That was their remaining balance on their loan. That's what they had to pay. So what they thought in their mind was, okay, so really our equity on this is we've got, we've got around $32,000 of equity. So at the closing, they're like, okay, we should be getting $32,000 towards our next purchase. Yeah, that's all fine and dandy, but unfortunately, that's not how it works. So a lot of people, they have this misconception. Well, in reality, when you're selling a home, it's going to be net equity. This chunk of money, that's going to be eaten up pretty quickly. And you'll see why here in a minute. So again, you've got that purchase price, $434,900. And with this, the average price to sell a home is about 8 to 9%. So 6% for commissions, and then you've got on average around 2% for the closing costs. So what you're paying title to close on that transaction, your title insurance, so on and so forth. So that's the average. So what we have here is you do 8%, that's going to be 34. That's going to be 34,000. Or let me triple check, make sure that's right. Make sure I'm not totally, let's see, 3,400 times 0.08. Yeah, 34,792. 792. So what does this give you? Well, really, your actual equity in that home is 400 and some change. So going back to, they had 402 that they owed on their loan. So what really the situation they're in, if they sold at that same purchase price, is $2,000 in the hole. So they are actually going to pay $2,000 to sell that home. And that's part of the reason why this made sense in this situation. I'll get to what the actual agreed upon terms were, to where we were able to put some cash in the seller's pocket. So $2,000, they were going to pay that to sell their home. Not ideal. So we explained that to them, and then explained, hey, this is what kind of the range on what we could get you cash to seller. That way you're not paying. And of course, we'll take care of the rest. We're going to pay all the closing costs, realtor commissions, so on and so forth. So that ended up working out for them. Now, I'm going to give you the terms. Now, the terms on what we agreed upon is we went with, and we indicated to him like, hey, so instead of paying, what we're going to do is we're at close of escrow, we're going to give you $7,000. So $7,000 cash to seller. So instead of them paying, we're going to pay them $7,000. And then as far as the realtor commissions, we negotiated it to is around, we had negotiated it on like 2.5% in that range of a $430K purchase price. So for them, realtor commission, $9K commission. So that brings us to $16K. Now with our closing costs in there, our closing costs ended up being, it's like $5,500. I want to say it was $5,500. Let me check, just make sure. Yep, $5,500. $5,500, which brought us up to about 21,000 in the deal. So 21,000, that's right around 5%. So pretty close to 5% of the purchase price is what we paid to get into this deal. And the terms on that, so we're giving them money, we're paying all the closing costs and the terms were, one, that remaining mortgage at 4.5%, we take over payments on that. So again, we're buying it subject to that. But in the interim, we are doing what is called a lease purchase agreement. So we're going to lease it, and we said 12 months. So 12 months lease purchase. And we had that at the lease amount was 125% of what their monthly mortgage payment was. And again, that's to help them wipe off the DTI on their next loan. And we've done this multiple times. We know it works. So we wanted to, we indicated to them, hey, we're not going to execute on this lease purchase agreement until you can qualify for your next loan. We want to make sure, we don't want to be a hindrance for you getting to that next home. So what happened here is, again, this 125%, I just want to detail that we indicated that the portion that was going towards the monthly mortgage interest, that was going towards pay down, or the mortgage, just the monthly mortgage as a whole, the whole PITI, that was going towards the pay down. Anything in excess, that was going towards our cash at end of closing. So when we choose to execute on that purchase, that's going to be a credit on our statement at the title company. So that's how we structured that. So what ended up happening is, again, we agreed on this, good to go. And what do you know? Within a month, they're saying, hey, we're working with this new builder, and they actually have the exact model we're looking for. We were thinking it was going to be 6-8 months down the line, but they actually have the model that we're looking for finishing next month. I'm like, oh, perfect. So we went through the process. We got them approved for their next loan. And again, we were able to get this note completely 100% wiped off of their DTI. And with that, they qualified for that next home. We waited until it closed, everything signed. They have ownership of that property. And then that same week, we said, okay, we are going to execute our purchase on this lease purchase agreement. So this all happened in a matter of a little over 2 months. So they closed on that first house that Friday of that week. No, it was Thursday that week, sorry. Thursday of that week, we closed on the purchase of this home to where the ownership transferred to us. Again, the deed transferred to us, the note remained in place, and we got that 4.5% interest rate. Absolutely awesome. Super cool. But best part about this is I say I own it. I don't really own it. Guess what owns this? My IRA owns it. So the IRA was on the purchase agreement. The IRA, all I did was administratively manage this. I structured the deal, and then the IRA purchased it. Awesome. Super awesome. Now, let's get into... All right, so exit. Now, what are we going to do with this property? So the exit on this one, and again, still in communication with the sellers. This was such a good option for them. They were ecstatic about it because they were actually making money on it instead of having to pay for it. So it was a really good option for them. I'm still in communication with them. Probably going to do I'm going to do a video with them here in the next few weeks because I want to show kind of a testimonial. That way people can see like, hey, what was this service like? How did we do? What was that like? Was this a good option for you? Why was it a good option? So on and so forth. Because they're really nice sellers. I'm glad we were able to help them out. So exit strategy on our end, what we got is we had one I underwrote it with 2 options. So I knew as a long-term rental, the PITI on it is around $2,900 and some change. That's including everything, principal, interest, taxes, and insurance. And it also, because it was an FHA loan that they purchased it with, they had PMI, so private mortgage insurance, and private mortgage insurance. So that really bumps this number up, which that's unfortunate. So I knew for a fact with the market that it's at, definitely not going to cash flow as a long-term rental. But I own a property management business. I know in that area what a monthly rental can pull. I also know say if a co-living model, not so much. I've got an idea. I don't manage co-living models, but definitely from a monthly rental perspective, a short-term rental perspective, most definitely know that. So I knew exactly what it could pull. So my first option, what I was going for, monthly rental. Now really in a monthly rental on this property, I could cash flow gross a little over 1,000. So it was a little over 1,000 plus a month, 1K plus per month. So gross, so you take into account utilities, expenses, capital expenditures, vacancies, stuff like that. Really the monthly cash flow would come down to around $500 to $600 a month. So true full net cash flow. That's really good. Those are solid numbers. But that's all fine and dandy. But really what I want to do is I want this to actually be an affordable option for someone to purchase a home. So I'm going with this second route. And mind you, this is still in the progress. This is still in progress because what I mentioned on the outset is this is a deal that we just took down very recently. So this is like pretty much live for y'all. But we are now working on the exit strategy. And the exit strategy, what I'm going to do is called, again, going back to that lease option. I want to lease option it to a home buyer. So lease option to somebody that is looking to buy a home. And why do I want to do it this way? So what I'm looking to do is I want to house people that are, one, they're unbankable. So they're self-employed and they're unable to qualify for a loan because they haven't met the length of time that the bank needs to see for self-employment income. So that's unfortunate. Those guys, they're still making decent money. They need a home. They still need a home. They can't qualify the traditional route. I'm also looking for first-time home buyers. So that's kind of the target market here. So lease option, so they can get into the home at an affordable price. And what I'm looking to do is to make it so in 3 years down the line, when I've got confirmed they've made all those payments, I'm going to let them take over at that same rate. So they're going to be able to stay at that same rate. Or if the rates are better by then, by chance, then they can refinance out and just go that route. Now, if they do take over this rate to protect that original seller, there's still going to be an option for me. If they default, I can take it back because the most important thing to me is we need to protect that original seller and make sure that they're protected. So again, 3 years down the line, and yeah, that's the route. Really, this is the route we're going. What it's going to be is, we figured probably going to be about a $10,000 option fee. So they're going to have the option, if you put down $10,000, then in 3 years you can purchase the home at such and such agreed upon price. Now that's going to be up for negotiation. Got some ideas of where that might be, but it's going to be 10K. So they could essentially get into a home for 10K and then have the monthly payments. And the monthly payments, I'm going to make it so those actually go towards, they're going to go towards the pay down. So when they do go to purchase a property, they're going to have some of it paid down. Again, I want this to be helpful for somebody. But at the end of the day, say 10K option period, plus there's some additional income that comes out of this. But really the 10K, remember, we only had, what is it, 21,500? 21,500 in the deal. I say 10K, that initial option fee, right off the bat, gives me over 50%, almost a 50% return. That's awesome, guys. So really cool stuff there. Again, this is a deal breakdown. And yeah, if you guys have any questions, I hope this was helpful for you. This stuff is like super exciting to me. If you're interested on like where I learned this stuff, as far as seller finance, subject to type stuff, I learned it all from being in this community. It's called Sub2. So it's a community that Pace Morby leads. And I learned everything from him, as well as people within that community. It's awesome. It's good stuff. I was in real estate before, doing everything the conventional route, and then going this route. It's been a complete game changer. Really cool stuff. I have a link to that. If you do want to get a discount to get into that community, feel free to take a look at that link. If not, again, there's a lot of free content on this stuff. It's a really good way to purchase real estate. But again, hope it was useful. Hope it was valuable, and I'll catch you on the next one.